What many investors don't realize is that millions of Chinese retail speculators had already begun experiencing catastrophic losses on their gold positions before the global sell-off even began. In a single trading session, approximately $15 trillion in market value evaporated as precious metals experienced one of their most dramatic collapses in modern history. Silver and gold prices plummeted in ways few analysts had anticipated. But the roots of this massive downturn actually trace back several days earlier to developments happening thousands of miles away in China. What many investors don't realize is that millions of Chinese retail speculators had already begun experiencing catastrophic losses on their gold positions before the global sell-off even began. This represents what could be characterized as the largest precious metals blow-up in financial history. While market participants are desperately hoping that the worst has already passed, the evidence suggests that far more turbulence lies ahead, particularly when Asian markets reopen and Chinese investors react to the carnage that unfolded while they were offline. The situation surrounding precious metals appears poised to intensify significantly when trading resumes, especially in gold and silver markets. Understanding the full scope of what transpired and why it happened is essential for anyone looking to navigate these treacherous waters. More importantly, identifying the specific opportunities that emerge from such extreme market dislocations can position traders to capitalize on unprecedented price movements in the metals sector. The truth is that despite the severity of Friday's collapse, multiple factors indicate that additional downside pressure is building and could manifest as soon as markets open for the new week. The backdrop to this crisis involves the People's Bank of China's well-documented accumulation of substantial gold reserves. What hasn't received adequate attention until now is the parallel speculative frenzy that gripped Chinese retail investors. Platforms like Jiwu Re represent just one among hundreds of small and medium-sized investment vehicles operating across China that have been using social media channels to attract everyday investors into the precious metals bull market with promises of rapid profits. As gold and silver prices climbed relentlessly higher, the returns being generated completely overshadowed what stocks and cryptocurrencies were delivering, which naturally drew massive speculative capital into these markets. The combined force of central bank buying from the PBOC, alongside Chinese and American retail investor enthusiasm, propelled precious metals prices into parabolic territory. However, a critical problem emerged that would ultimately trigger the unraveling of this entire structure. Investors who had purchased gold through popular online platforms suddenly discovered that these companies were unable to release their funds in full. When people cannot access their money, panic spreads rapidly through word of mouth and social networks. This sparks a rush as more and more participants attempt to liquidate their positions to extract whatever capital they can before losses mount further. The cascading effect proved devastating. Multiple platforms encountered similar liquidity issues over recent months, with aggregate potential losses estimated at 10 billion yuan, equivalent to more than $1.4 billion. When gold and silver experienced their sharp Friday decline, these losses expanded exponentially beyond even these staggering figures. Hong Jian, a Shenzhen-based attorney specializing in investment disputes related to gold, identified the fundamental weakness in this system. Many smaller investment platforms lack proper risk management mechanisms to hedge against violent price swings. This structural vulnerability played out repeatedly throughout the previous year as prices became increasingly disconnected from rational valuations. The core issue stems from how prices in China's domestic markets have inflated well beyond international benchmark levels. These exaggerated valuations mean that any whipsaw price movements get magnified in ways that cause these smaller firms to face insolvency. Despite massive inflows into major Chinese gold ETFs reaching record levels on Friday, the sell-off in U.S. markets occurred while Chinese exchanges remained closed for the weekend. This timing creates a dangerous setup for when Asian trading resumes, as Chinese investors will wake up to discover the extent of losses that accumulated overnight. The inevitable rush to liquidate positions and salvage whatever value remains will add tremendous selling pressure to markets that are already severely stressed. Compounding the pressure facing precious metals is an impending increase in margin requirements across gold, silver, palladium, and platinum futures contracts. Both standard and heightened risk profiles will face higher collateral requirements. This regulatory change means that anyone wishing to maintain futures positions in these metals will need to deposit additional cash to meet their obligations. The practical effect of higher margin requirements is to squeeze out smaller market participants who lack sufficient capital reserves to post the necessary deposits. The timing of this margin increase carries significant implications. The new requirements take effect after markets close on Monday, which gives current position holders a narrow window to either add funds to their accounts or exit their positions voluntarily before forced liquidations occur. This compressed timeframe virtually guarantees a wave of selling, as traders who cannot or will not meet the higher margin standards dump their positions into an already fragile market. The combination of retail panic selling from China and forced liquidations due to margin calls creates a perfect storm of downward pressure. Another major source of selling pressure comes from systematic trading strategies employed by commodity trading advisors and quantitative funds. According to Morgan Stanley's analysis, CTAs entered Friday with substantial long exposure to precious metals. These systematic strategies held an estimated $5 billion net long position in silver, representing the 94th percentile relative to the past 5 years. Their gold exposure stood at $15 billion net long, which sits in the 56th percentile versus the 5-year historical range. These statistics reveal that systematic traders accumulated massive bullish bets on silver in particular. The algorithmic nature of these strategies means they will mechanically continue closing out long positions as their trend-following models generate sell signals. More concerning is the possibility that these programs could flip from long to short positions if downward momentum persists, which would add fresh selling on top of the unwinding of existing longs. The systematic nature of this selling means it will continue relentlessly regardless of fundamental considerations until technical indicators signal a reversal. The proliferation of leveraged investment products tied to precious metals adds another layer of instability to the current situation. Over the past 12 months, investors purchased more than 400 million shares of leveraged precious metals ETFs, including products like the ProShares Ultra Silver ETF that delivered returns exceeding 350% over that period. On Friday alone, 38 million shares changed hands as some buyers attempted to step in and catch the falling knife. However, if silver prices continue declining, the mechanics of leveraged products will force additional selling that creates a vicious feedback loop. Leveraged ETFs must maintain their target exposure ratios by buying more of the underlying asset when prices rise and selling when prices fall. In a declining market, this dynamic becomes destructive as the products automatically sell into weakness, which pushes prices lower, which then triggers more forced selling. Traders who bought these leveraged products near the peak are experiencing devastating losses that will likely force many to capitulate. Each wave of capitulation selling drives prices lower and triggers the next round of forced liquidations from leveraged product rebalancing. Christopher Wong, a strategist at a major Chinese banking institution, captured the essence of what is unfolding when he described the situation as markets finding an excuse to unwind parabolic moves. His observation that bubbles follow a pattern of fast up followed by fast down perfectly describes the elevator shaft decline happening in precious metals. Parabolic price advances are inherently unstable because they rely on a constant influx of new buyers willing to pay ever higher prices. Once that buying momentum breaks, the descent happens far more rapidly than the advance because fear is a stronger emotion than greed. Examining the typical life cycle of a financial bubble provides crucial context for understanding where precious metals currently sit in that cycle. Every bubble follows a predictable psychological pattern that moves through distinct phases. The initial advance creates excitement as early adopters generate profits. This success attracts broader participation, which accelerates price gains and validates the bullish thesis. As prices enter parabolic territory, euphoria takes hold, and rational valuation metrics get abandoned in favor of narrative-driven speculation. The peak arrives when the last marginal buyer enters the market and no fresh capital remains to push prices higher. What typically follows is an initial decline that creates confusion and denial among participants who have only experienced rising prices. Many interpret this first pullback as a healthy correction that presents an attractive buying opportunity. This psychology creates what gets termed a bull trap, where prices temporarily stabilize or bounce as dip buyers step in, convinced they are getting a bargain. Friday's dramatic decline likely represents this denial and bull trap phase, which appeared to validate itself when buyers emerged late in the session to support prices. If this proves to be a temporary low, prices would be expected to rally as market participants convince themselves that the worst has passed, and that this represents an excellent opportunity to add exposure at discounted levels. However, The lesson from countless historical bubbles is that this relief rally sets up the truly devastating phase of the cycle. Once the bull trap rally exhausts itself, reality sets in that fundamentals cannot support elevated prices. This recognition triggers the return to normal phase, which quickly morphs into fear as losses mount. Panic eventually takes hold as even steadfast believers abandon their positions. The final capitulation phase sees prices overshoot to the downside just as dramatically as they overshot to the upside during the euphoric advance. Understanding this psychological progression is essential for anyone attempting to trade precious metals in the current environment. Goldman Sachs' analysis reveals another crucial factor that will influence how this situation unfolds in coming sessions. A record volume of call options on gold and silver were purchased during the recent advance. Call options grant holders the right to purchase the underlying asset at a predetermined strike price, which creates leverage to profit from rising prices. The dealers who sold these call options must hedge their exposure by purchasing the underlying metal as prices rise, which mechanically reinforces upward momentum. This dynamic worked in reverse during the decline, but the truly significant impact remains ahead. As these record volumes of call options approach expiration, dealers who sold them will need to unwind their hedges by selling the underlying gold and silver. The sheer quantity of these positions means this unwinding process will dump massive supply into the market, right as it attempts to recover from Friday's decline. This creates a situation where any relief rally faces a wall of selling from options-related hedging activity that will cap upside potential and potentially trigger another leg down. While media coverage attributed the precious metals collapse to President Trump's nomination of Kevin Warsh as the next Federal Reserve Chair, the reality is far more complex. Markets had priced in expectations of extreme dovishness from the Fed and even feared that central bank independence might collapse under political pressure. Warsh's reputation as a hawkish policymaker focused on balance sheet reduction immediately restored credibility to the institution. This shift in expectations regarding monetary policy provided a catalyst for speculative excess to exit precious metals positions. However, as the evidence clearly demonstrates, the crisis originated days earlier in China's retail gold markets rather than from any single news event. The Warsh nomination simply provided a convenient narrative for media outlets to explain price action that had deeper structural causes. Chinese speculators discovering they could not access their funds created the initial panic. This spread through social networks and triggered cascading liquidations that spilled over into global markets. The sequence of events reveals how interconnected modern financial markets have become. Problems that begin in relatively obscure corners of China's retail investment landscape can rapidly transmit to major global commodity exchanges. The timing of when different markets are open or closed creates gaps where pressure builds unobserved, only to explode when all participants can react simultaneously. Understanding these transmission mechanisms is essential for anticipating how events will unfold when Asian markets reopen. Multiple forces are converging to create exceptional volatility when trading resumes for the new week. Chinese retail investors will face their first opportunity to react to the massive losses that accumulated while their markets were closed. The natural human response will be panic selling to prevent further deterioration in account values. This wave of liquidations will hit markets that are already reeling from Friday's action. Simultaneously, the margin requirement increases take effect after Monday's close, which gives participants minimal time to decide whether to meet the higher standards or exit positions. Many will choose or be forced to exit, adding to selling pressure. The systematic trading algorithms continue grinding through their position unwinding regardless of other market dynamics, contributing steady selling into any bounces. Leveraged product rebalancing will amplify moves in both directions, but particularly to the downside, given how far prices have already fallen. The options market dynamics mean that dealers need to sell substantial quantities of physical metal as call positions expire worthless. Each of these factors alone would create challenging trading conditions. Their simultaneous occurrence creates an environment where extreme volatility is virtually guaranteed. The question becomes whether prices can find a sustainable bottom, or whether additional capitulation lies ahead. The classic bubble psychology pattern suggests that Friday's low will likely be tested and potentially violated as the bull trap phase completes. Only after maximum pain has been inflicted on remaining bulls would conditions be ripe for a genuine bottoming process to begin. For those currently holding long positions in gold, silver, or other precious metals, the prudent course of action involves looking for opportunities to exit during any strength that emerges. Hoping for a return to previous highs in the near term conflicts with the overwhelming evidence of structural selling pressure that remains in the market. Any rally should be viewed as an opportunity to reduce risk rather than add exposure. Experienced traders with appropriate risk tolerance and sufficient capital might consider tactical short positions, but timing proves crucial. Shorting into the teeth of Friday's decline carries significant risk of getting squeezed during a relief rally. The more strategic approach involves waiting for that relief rally to develop and then establishing short positions as evidence emerges that the bounce is exhausting itself. This requires patience and discipline to avoid premature entries. Jeffrey Gundlach, a highly respected bond investor, has recommended that investors maintain approximately 20% of their portfolios in cash, specifically to take advantage of opportunities that emerge during market dislocations. For those interested in precious metals on the long side, the classic bubble cycle pattern suggests that patient investors will see prices return to levels that currently seem impossible. Rather than trying to catch a falling knife, maintaining dry powder to deploy at truly attractive valuations makes far more sense. Short-term Treasury securities represent an alternative to holding pure cash while waiting for better entry points. These instruments provide some yield while maintaining liquidity and safety of principal. The long bond market remains in its own precarious technical position and deserves careful monitoring, but rushing into positions there carries its own risks. The primary focus should remain on capital preservation and maintaining flexibility to act when genuine opportunities present themselves. The key insight is that bubbles create their own dynamics that override normal fundamental analysis. Trying to value gold or silver based on traditional metrics proves futile when leverage unwinds and forced selling dominates. Waiting for stability to return and for panic to exhaust itself represents the higher probability path to successful investing. Placing current events in historical perspective reinforces how unusual and potentially dangerous this environment has become. The single-day declines recorded on January 30th rank among the most severe in decades. Gold falling 16% from levels above 5,500, and silver cratering nearly 40% in intraday trading haven't been witnessed since the 1980s. Platinum and palladium suffered similarly devastating losses. What makes these moves particularly remarkable is they occurred when virtually no market participants anticipated such a reversal. Bullish sentiment had reached extreme levels, with numerous analysts predicting that precious metals would continue climbing indefinitely. This universal optimism itself served as a contrarian warning signal that gets ignored during euphoric phases of bubbles. The 1980s comparison is instructive because that period saw precious metals peak at levels that wouldn't be revisited for decades. Investors who bought near those highs endured years of losses before breaking even. The current situation may not replicate that exact pattern, but it serves as a reminder that parabolic advances create equally dramatic reversals. Understanding how previous bubbles resolved provides a roadmap for what to expect going forward. Initial declines shock market participants, but don't immediately break bullish conviction. The relief rally that follows creates false hope and draws in one final wave of buyers. Only when that fails does the full reality of the situation become apparent, triggering genuine panic and capitulation. Navigating precious metals markets over the coming days and weeks requires clear thinking and emotional discipline. The volatility will tempt traders to make impulsive decisions based on short-term price action. Maintaining perspective on the larger structural forces at work helps avoid costly mistakes. For existing long positions, the evidence overwhelmingly supports reducing exposure during strength, rather than hoping for a miraculous recovery to previous highs. The selling pressure from China, margin calls, systematic strategies, leverage unwinding, and options market dynamics creates a perfect storm that will take time to resolve. Traders considering short positions need to exercise patience and wait for the setup to develop, rather than chasing prices lower. The relief rally will present far better risk-reward opportunities to establish short exposure than trying to short into an already oversold market. Patient investors should view this period as one where capital preservation takes priority over aggressive positioning. Markets that have experienced the kind of dislocation seen in precious metals need time to find equilibrium. Trying to precisely time the bottom proves far more difficult than waiting for clear evidence that a sustainable low has formed. The situation will continue evolving rapidly as each trading session brings new developments. Staying informed about positioning data, technical levels, and market structure provides an edge over those reacting purely to price action. The traders and investors who remain disciplined, patient, and flexible will find opportunities to profit from this historic dislocation in precious metals markets.